What's up, traders? In this video, I'm going to reveal the 3 traits that separate the wildly successful traders from the ones who are on the verge of blowing up their accounts. Forget about generic advice on discipline and patience. I'm talking about traits with real solutions that can be changed right now. And these traits have been shown to separate winning traders from losing traders time and time again over millions of trades. And I'm not the only person who's noticed this pattern. Traders like Tom Hugard, who worked at one of the biggest bond brokers in the world, and his friend, who was the CEO of one of London's largest trading companies, spent decades watching thousands of traders take millions of trades, and both agree that successful day traders do these 3 things completely differently than the 90% of losing traders. And one of the most notable traits that separates winning traders from losing traders is how long they're in a winning trade versus a losing trade. And no, I'm not talking about a trader's win rate. I'm talking about how much time a trader spends holding their winning trades. Most losing traders actually have more winning trades than losing trades. Their win rate is not the problem. The problem is that when they have a losing trade, they lose 66% more than their winning trades. That means that the number one reason why most traders fail isn't because of their win rate, it's because they're holding on to losing trades far too long. And the second trait that determines whether a trader will be successful is whether a trader adds to winning trades or losing trades. Imagine that you had 2 stocks in your portfolio and you needed to sell one of them to purchase a house. Would you sell the stock that is overbought and at all-time highs that already made you a lot of money, or would you sell the stock that's currently oversold and super cheap? After watching millions of traders over decades, the data shows that most traders will not only hold on to the losing trade that is currently on sale, but they'll also add to their losing positions in an attempt to buy low and sell high. And it's these traders who consistently lose money. And the third trait that determines whether a trader will be wildly successful or continue to lose money is trade frequency. And by that, I mean how often somebody trades and how many trades they take. Overtrading isn't just some bad habit, it is one of the deciding factors in whether a trader will make money or lose money. And the data does not lie. Over those millions of trades, traders who consistently lost money took dozens more trades than successful traders. And that's because most traders don't take overtrading seriously. I know I didn't. I used to be the absolute worst at overtrading, sometimes taking up to 30 trades in a day. And honestly, at the time, I didn't see a problem with it. I thought I was getting more trading experience, but really, all I was doing was creating bad habits of chasing money and trading anything and everything. So you can see there's a bit of a pattern here. Most traders hold on to stocks that they think are cheap. They sell stocks that they think are expensive. They buy as the stock becomes cheaper, and they go for quantity over quality. What I'm saying is that most traders treat the stock market like it's a giant yard sale, where they can pick up neglected items for a bargain and hope to sell them for a small profit. But here's the thing, the stock market isn't a yard sale. It's more like an auction, and smart traders know that. That's why they think differently. Because at an auction, the idea isn't to find something that nobody wants, it's to find something that everybody wants and is willing to pay more for. That's why smart traders don't worry if something is too expensive. They understand it's a lot easier to sell something that everyone wants rather than something that's on the verge of being thrown away. Because at an auction, there is no such thing as oversold and overbought. The goal is to buy high and sell higher. But that's the problem. It's human nature to want to buy something we think is undervalued and sell what we think is overpriced. So let's go over an example and tell me if this sounds familiar to you. So you see a stock that you really like AMD. You know that it always goes up. So you see it pull back like this and you think it's on sale. So you enter your trade right here. As it goes up, you get excited, and then you start feeling like it's overbought or it's too expensive. And then you start seeing right here that's having some problems and starts to pull back. So what you do is you start to spaz out and you close on a profit. So then you're feeling really good. Let's say you made $1,000. So you're feeling really great. You're feeling on top of the world. You feel like you're really good at day trading. But then the next thing you know, the stock continues and it just goes up and up and up. And then you look back at the day and you realize that all you had to do was keep holding on to that trade to make a ton of money. But instead, you worried at this little pullback and you completely closed your trade. But then good news, immediately in the aftermarket, the stock collapses. So what do? You see that the price comes down. So you buy it here. and then it keeps going down. So maybe you buy some more here, and then it keeps going down. So then maybe you buy some more here. And then as this trade plays out, we get really lucky where it looks like it goes all the way back up and then we're at a profit. But the problem is by the time it comes back up, we're so nervous about how much money we lost that we end up selling right about here for a break even. So we go back to $0 and we're just so happy that we don't have to take that huge loss. And then the next thing we know, the stock market goes up even higher and up and up and up, and that we missed this huge move all the way back up. So you can see this creates this terrible habit where most traders are always fighting the market. They're always buying while it's dropping, then they're adding into their losing positions. And then when they either get lucky and make profit or get back to break even, they feel like that's a good strategy because they're able to make some money or get back to break even. But you see what's really happening if we take a look at just this first trade, they risked this much money just to come back to a break even. That means they're risking all this money for literally no profit at all. And then it's the same thing for their previous trade where they entered here. Like where was their stop loss? How long would they buy on the way down? So how much are they really risking in this area? And let's say that even if they did use a stop loss, which let's say was down here, and then when they sold up here, well, how much did they really make? I mean, if you look right here, they risked more than they actually made. So then if they want it to be profitable, they would have to be right almost all the time so that they can make this tiny little profit for how much they're risking. And it's the same thing with their trade over here. They risked this massive amount, then they risked even more, and then they risked even more, and they just got lucky that it turned around and they got back to break even. So they have this huge risk and no profit whatsoever. Not only that, but they're buying things that are cheap, which means that they're always buying something that's on a downward trajectory. That means that they're always fighting the market. The market comes down here, so they fight the market and they buy. Then it comes down further, so then they buy more. They're always fighting the market. Then when the market goes up, they freak out and they sell. And then it goes up too high, and then they might even short it. They're always arguing with the market. They think that buying low is good and selling high is good. They think that everything in the stock market should be perfectly valued at all times. If it's too expensive, then it should come back down. If it's too cheap, then it should go back up. But that's not how the stock market works. The stock market is an auction, which means that things that are in high demand can go up and up and up for years and years and years. So now real quick, let's run through an example of what a successful trader might do just by trying to buy high and sell higher while buying with the trend. So as you can see here, the stock market came down, so we do not want to buy that whatsoever. We only want to go with the stock market. If something is on sale, I want to stay far, far away from it. And then once it comes up here, we can see maybe it's starting to form a trend upwards. It makes this resistance right here and then breaks out. So now we have a higher high with this higher low. So that's starting to look good. It's starting to form this uptrend. And then once you decide that this forms an uptrend, you can start looking for buys in the breakout of the direction. So let's just say we're being aggressive and we buy right here on this first one. What we're going to do is we're going to have our stop loss. So we put that down here, back at the previous support. And now what we want to do is we want to hold on to this for at least 3 profit, which would be somewhere probably right around here. And the more successful a trader is, the better they are at holding on to their wins. So somebody who's on the verge of being a more successful trader might hold this for the 3 profit and then sell here and make some money. And as you can see, that gives them a really good risk to reward ratio. That means they only have to be right about 35% of the time, and they're not arguing with the market. They're trading with the market. Whereas a really successful trader might hold on to their trades for even longer, and they might even start trying to add into those trades. So here we see another breakout confirming another high. Maybe they add into there. So they put their stop loss down here. It breaks out, and then they don't sell it because as it starts coming back, they're still hoping that it'll stay in this uptrend right here. So as it comes back, they keep their stop loss really large, like down here, or maybe they raise it a bit up here. It comes back down. It doesn't hit their stop loss. It starts coming up. It struggles a bit, and then it breaks out again. So if they're really aggressive and a really successfully minded trader, they could even add again here. So they add again, they raise all their stop losses up here. It keeps going up. And then once it's the end of the day, they close their trade because I personally don't hold trades in the aftermarket or for the next day. That's really risky. Or bare minimum, they trade in the aftermarket and they get stopped out somewhere down here once this gets way too aggressive and turns around against them. And as you can see, they have multiple winners in the direction of the stock. And now I'm not saying that you need to start adding into your winning positions like this aggressively or that you need to hold stocks forever. What I am saying is really start to be aware of how long you hold on to these winning trades, because this is key to becoming a successful day trader. If you're this guy who originally risked this much money potentially and you made this much money, you're going to lose money day trading all the time. So stop trading like you're looking for a bargain, like you're at a garage sale. The point is to buy high with the trend and then sell higher. So the goal is to hold on to your winning trades as long as you can. The longer you hold on to these trades without being stopped out, the more likely you are to make a lot of money. I mean, really think about it. How can anyone make money day trading or have a big winner if the second that it becomes overbought or too expensive that they sell their position? Like if you bought here and then it becomes overbought up here, then how are you ever going to have a large winner all the way up here? And even worse is a lot of these people who are treating the stock market like it's a garage sale, they're going to fight this market all day long. They're going to see a way up here, think that's overbought, and then the second it turns around, they're going to try to short it. And yet again, there is barely any money to be made there. It comes back up, they think it's overbought, comes down a little bit, so they short it, and then there's no money to be made. Comes back up, now they think it's really too expensive, goes down a little bit, so they short it, and there is no money to be made. If you want to be a winning trader, you need to think differently. You need to be fearful when a trade is at a loss and hopeful when a trade is in profit. And to do this, you need to make it your goal to hold on to these winning trades as long as possible. Winning traders understand that the longer they're in a winning trade, the more likely their trade will pick up momentum. And now, not every trade picks up momentum every time, and that's fine. But regardless, our goal is to practice being in trades as long as possible. And the better you get at this, the better you'll get at agreeing with the market, holding on to your winning trades, adding to your winning trades, and making a lot more money. And so obviously mindset is extremely important, but what can we do as a new trader to immediately stop over trading and start holding on to these winning traders? 2 words: trading rules. Every great trader has a set of rules that they follow. So here are the 7 rules to stop over trading. Number 1, out of millions of trades, the traders who consistently made money day trading were traders who use stop losses. So if you're not already using a stop loss on every single trade, it's time to start right now. No excuses. Determine your stop loss and enter a stop loss before you even enter a trade. Number 2, if your stop loss gets hit, then move on. Never re-enter a trade when getting stopped out. Think about it this way. What's even the point of using a stop loss if someone's just going to re-enter their trade anyway? Doing that is the same as risking twice as much on that trade. And not only that, but it was already proven to be a losing trade. So basically what you're doing is you're risking twice as much on your losing trades. And even if a trader re-enters a trade and it works out, that's even worse. If a trader is being rewarded for breaking the rules and re-entering losing trades, they'll just continue to fall into those bad habits time and time again of overtrading, buying losing trades, and losing money. And number 3, start practicing risking less money. It's extremely hard to watch a ton of profit turn around and become a losing trade, and it's even harder not to start re-entering trades and overtrading after losing a ton of money. And number 4, start using a profit target that is at least 3 times as much as you risked. So if here is your risk, make sure that this right up here equals at least 3 times how much you risked. And then don't close your trade until it hits your profit target. Otherwise, you're just going to be selling every single time you think that the market is overbought, and then you're going to be over trading all over again. Number 5, limit your day trades to only 1 trade a day and limit your swing trades to only 3 trades a week. There's no reason why you should be trading more than that. Remember, most professional day traders take fewer trades than that, and they do even better the less they trade. The goal is to break the habit of overtrading. And number 6, stop watching the stock market all the time. There's no point in watching your trades when you can't close your position until it hits your stop loss or your profit target. Watching your trades play out isn't going to make the trade do any better. You entered your trade plan for a reason, so let the market play out. So instead of watching the market, start setting price alerts at important levels where you might want to enter a trade and let those trades come to you. For example, if you see that there is this level of resistance right here, then enter a trade alert at that target so that when the price gets there, you get the trade alert and then you can look at this chart and decide if you want to take the trade. That way, you're not watching the market all day. And number seven, decide on one strategy to trade and then only trade that one specific strategy. What I like to do is I like to trade one simple pattern, such as an ascending triangle or pennants, and then I only buy on the breakout in the overall trend. Doing this helps limit my trades and ensures that I'm only taking the best setups. So, for example, a strategy that you could use that I really like is only looking for these ascending triangles like this, and then buying on breakouts in the direction of the overall trend. And then that way, you're going to get really good at this one strategy of finding these patterns and then buying on the breakout in the direction of the overall trend, and you can really master this one trading strategy. So if you want to be part of the 10% of successful day traders, then stop treating the stock market like a yard sale and start treating it like an auction. And if you want to learn more about day trading, then feel free to subscribe and check out my personal trading guides and trading checklists that I think will really help you out. I've uploaded them for free in the description below, and I still use that trading checklist to this day to take some of my very best trades. And if you really want to take your trading to the next level, then sign up for my one-on-one mentoring so I can personally coach you and create a customized game plan. So until next time, take it easy on yourself and you've got this.